Hey folks, let's talk about who can claim a deemed paid tax credit. A domestic C corporation that owns 10% or more of the voting stock and receives a dividend distribution from that corporation. A domestic C corporation that is a partner in a partnership and it owns stock of a foreign corporation. What is a dividend? It is a distribution of property out of a foreign corporation's earnings and profits. Code section 302D, stock redemption, and Code section 1248, gain on the sale of stock of a controlled foreign corporation. US citizens or resident aliens are not eligible for deemed paid tax credit. S corporations, partnerships, estates, or trusts are not eligible for deemed paid tax credit. If S corporation structures its foreign operations as a branch or a partnership, its shareholders can claim a direct credit for foreign income taxes incurred by the foreign branch or partnership. US citizens and resident aliens can take advantage of the 20% maximum US tax on qualified dividend income, which includes dividends received from foreign corporations that reside in the countries that have entered into an income tax treaty with the United States. Pooling rule. What do we do in the pooling rule? Determine the amount of foreign income taxes that are attributable to a foreign corporation's dividend distribution. If a foreign corporation distributes all of its after-tax earnings, determination of foreign tax credit is not difficult. The foreign income taxes related to each year's dividends are the foreign taxes paid in the taxable year. If a corporation does not distribute all its earnings and profits each year, it will lead to a tracing problem. We can resolve this issue in one of the two ways. Number one, assume that dividend distribution is in chronological, that is a first in, first out approach, or in a reverse chronological order, that is a last in, first out approach. Pool undistributed earnings, profits, and foreign income taxes, and assume that a dividend distribution pulls out deemed paid taxes equal to the pool of foreign income taxes multiplied by the ratio of dividend pool of undistributed earnings and profits. Let's take a look at an example. We have a US co that owns 100% of Yorko, a foreign corporation. Yorko's earnings and profits, foreign income taxes, and dividend distributions for its first 2 years' operations are as follows. In the year one, it has $10 million in pre-tax earnings, $2 million in foreign taxes. Income tax rate is 20%. In year two, it has $10 million in pre-tax earnings, $4 million in foreign taxes, and the tax rate is 40%. Earnings and profits for first year equal $8 million, and for year two equals $6 million. Dividend distribution for the year one is none, and for year two is $3 million. Yorko, the foreign corporation, pays dividends of $3 million to USICO in second year. Because the foreign tax rate on Yorko's earnings increased from 20% in year one to 40% in year 2, the last in first out method would pull out more foreign taxes than the pooling method. Under the last in first out method, the 3 million dividend represents distribution of 50% of Yorko's year 2 earnings and profits of 6 million, and therefore the dividend pulls out foreign income taxes of $2 million. That is 50% of $4 million of year 2 foreign income taxes. Yorko has undistributed earnings and profits of $14 million. That is $8 million plus $6 million. And a foreign income taxes of $6 million. That's $2 million and $4 million added together. Therefore, under a pooling approach, the 3 million dividend pulls out foreign income taxes of roughly $1,285,714, calculated as 6 million of foreign income taxes multiplied by, in parentheses, 3 million dividend divided by 14 million of earnings and profits. A domestic corporation that operates abroad through multiple tiers of corporations can obtain a deemed paid foreign tax credit for taxes paid by lower tier foreign corporations down 6 tiers. Both upper tier and lower tier foreign corporations have to be members of a qualified group. So, what is a qualified group? A qualified group consists of a first-tier foreign corporation for which a domestic corporation may claim a deemed paid foreign tax credit, as well as any other foreign corporation if the domestic corporation owns at least 5% of the voting stock of the foreign corporation. Indirectly through the chain of foreign corporations are connected through stock ownership of at least 10% of their voting stock at each tier in the chain, and the lower tier foreign corporation is not below the 6th tier in the chain. Also, to be included in the qualified group, any foreign corporation below the 3rd tier must be a controlled foreign corporation in which the domestic corporation is a U.S. shareholder. Let's take a look at an example. We have a US ECO that owns 100% of F1. F1 owns 40% of F2, and F2 owns 10% of F3. F2 and F3 are foreign corporations. US ECO may claim the deemed foreign tax credit for the foreign income taxes paid by F2 because US ECO owns at least 10% of F1, which is 100%. F1 owns at least 10% of F2, 40%, and US ECO indirectly owns at least 5% of F2, which is 100% times 40% equals 40%. Even though F2 owns at least 10% of F3, 10%, because the indirect ownership by US ECO of F3 is less than 5%, which is 100% multiplied by 40% multiplied by 10% gives us 4%, US ECO may not claim a deemed foreign tax credit for foreign income taxes paid by F3. CFC and 1050 company look-through rules. Look-through rules apply to dividends received from either a CFC or a 1050 company. Look-through rules also apply to deemed paid credits. If a domestic corporation structures a foreign manufacturing operations as a branch, the related income and foreign taxes would be assigned to general limitation income. In contrast, if a domestic corporation structures a manufacturing operation as a subsidiary, absent a look-through rule, dividends distribution from the foreign manufacturing subsidiary would be assigned to passive limitation income. CFC and 1050 company look-through rules. To better equate the treatment of foreign branch and foreign subsidiary operations, dividends paid by a foreign corporation to a domestic corporation are allocated between passive income and general limitation income based on the ratio of foreign corporations' earnings and profits within each category of income to the foreign corporation's total earnings and profits. Let's take a look at an example. Forco has earnings and profits of 1 million. Attributable to general limitation is 900,000, which is 90%. Attributable to passive limitation is $100,000, which is 10%. The amount of deemed paid foreign taxes related to each separate category of income is calculated as below. Number 1. Post-1986 foreign income taxes related to category income times portion of dividend allocated to category of income divided by post-1986 undistributed earnings related to category of income. A domestic corporation must maintain separate pools of post-1986 undistributed earnings and post-1986 income taxes for passive limitation income and general limitation income with respect to any 10% or more owned foreign corporation. Folks, this information is for educational purposes only. It does not constitute any legal advice or opinion, so please do not use any of its contents without seeking a professional advice. I have prepared this presentation from Practical Guide to U.S. Taxation of International Transactions, 9th edition, written by Robert J. Missy Jr. and Michael S. Shadewalt. Publishers are Walter Clover, CCH Incorporated. Folks, my name is Mansoor Suhail. You may call me Manny for short. I'm an accountant operating out of Toronto, Ontario. My specializations are taxes for Canada and USA. My website is www.theaccountingandtax.com and www.taxserviceguru.com. Call me if you have any questions at 416-283-8774 or contact me by email at taxservicesguru@gmail.com. Thank you for listening.